Idag ska vi djupdyka i tillväxtmarknader och jag säger välkommen till 2 stycken väldigt seniora gäster. Välkomna hit. Jag tänker börja med dig, Fredrik.
Tusen tack, Magnus. Hyggligt att vara
här. Lars.
Tack, Magnus. Tack för invitationen. Jag tror att jag ska prata engelska, då ingen vill förstå vad jag säger om jag försöker snacka skandinavisk dansk.
Okay. So let's switch to English then. But let's start with you, Fredrik. I mean, could you give us a brief presentation of your background and who you are and what you're doing?
Yes, so my name is Fredrik Bjelland. I'm the lead portfolio manager of Sakgen Kon-Tiki, which is Sakgen's flagship emerging markets fund. I joined Sakgen back in 2017 as part of the portfolio management team. Prior to that, I spent almost 20 years working with equities, first as an analyst at Morgan Stanley, and then latterly working for the Norwegian Oil Fund or Norges Bank Investment Management, where I worked both in London and the last 3 years as head of China based in Shanghai before I returned to Norway and my roots in Stavanger and joined the team there.
Solid.
Thank you.
And Lars?
I'm Lars Krabbe, yeah, and I run the frontier fixed income team at Coeli as part of the team, and I've been doing that for almost 4 years now. And prior to that, I was 14 years at Bank Invest and running the broad emerging market fixed income portfolios. And prior to that, I was at Danske and Nordea doing similar stuff. So that's my background, more than 20 years in the emerging market business.
Very long background as well, very solid. So great to have you here both. I mean, let's start with the emerging market equities. I mean, I think it has been a good start to the year. I mean, comparing to some of the major markets having larger issues, I would say. I mean, quite some negative returns if you have been invested in the US market, for example, Nasdaq and S&P 500, whereas the Swedish stock market is almost flat. Yeah. But Fredrik, why should one consider to invest in emerging market, and what makes it so interesting right now?
Well, I think, first of all, we think that emerging markets play a good role in any diversified global portfolio. As many of your listeners or readers will know, it's where the most of the world's population lives. It's most of the landmass in the world and an increasing share of economic activity. But those things have been true for a very long time, and it hasn't helped returns from the asset class over the last 10 years. So I think it's also important to take into account that these are different markets. They're very heterogeneous, i.e. they're very different markets. What works in China doesn't necessarily work in Brazil. The cycles may be different. Political systems have stability or instability at different times. So I think it's really important to look at these markets on a one-by-one basis and then craft a portfolio which can sort of tap into the long-term structural growth while at the same time managing the risk through diversification. Timing-wise, we think it's interesting. As you said, the US markets in particular have been highly valued for some time now. They've started to come under some pressure. If you look relative to history, emerging markets as an asset class are lowly valued relative to history. And we saw in prior cycles, for instance, at the start of the 2000s, that low starting valuation and sort of a flight away from the US market has historically benefited emerging markets quite well. So the timing looks pretty good to us.
And still, I mean, as you said, it's a heterogeneous market, and you can't really compare China to Brazil. Well, you can, but I think the mix makes it interesting. But yeah. I think if we go through and look at China versus India, I mean, China seems to be fairly cheap historically, and India seems to be more moderate, right, or average valuation. What's your take on those two?
Well, I think the first thing to stress is that we are so-called bottom-up investors. So we're company focused investors. So we don't necessarily allocate capital to markets based on what the country is called. We look at where we can find undervalued securities. Of course, there will be times when certain markets are cheaper than others for maybe geopolitical reasons or cyclical reasons, and then we would typically find more opportunities in those markets. China and India are two of the most important markets in emerging markets. They account for almost 30% and almost 20% respectively of the index. They have large populations and high economic growth. But as you will be aware, they have very different political systems, they have very different demographic outlooks, and as a result, their valuations are also very, very different, because the Indian story top-down is very, very strong, lots of good companies, high economic growth, whereas the Chinese story, if you reverse sort of 18 months ago, people will have said China's uninvestable. Because of the geopolitical tension that we'd seen. But it is interesting to see, with 18 months of strong performance, people are now coming back into China. It's still cheap, but it's not as cheap as it once was.
And I think also another interesting aspect of this is that I heard that someone else told me that in the Chinese market, I think 75% of the participants are retail investors, whereas it's exactly the opposite in India, whereas in the Indian market, 25% of the investors are the retail investors.
Although I think this is changing. I mean, I was in India in the fourth quarter last year, and it struck me that the tone in the Indian market and the retail participation, particularly through option trading, had a lot of similarities with when I landed in Shanghai back in the end of 2014, when this was a booming market with lots of sort of powerful drivers behind it. What we see in a lot of emerging markets is the retail traders do set prices in sort of volatile periods. And it's one of the things that we think an active, more institutional manager can try and harvest, trading against that. That's why, again, in our fund, we are long-term, we are value-based, so almost the opposite of what your average retail trader would be.
When it comes to now the trade war going on and the tariffs that are to be implemented, how do you think that will affect the different emerging market, and who will be the winners and who would be the big losers?
I mean, that's almost a question for several series of podcasts. I think, first of all, we try not to make single macro bets. What do I mean by that? It means that we are not trying to have the catalyst being a macro-driven thing where we don't believe the companies can influence it themselves. It's instead part of our risk assessment. So we will run different scenarios when we set our expectations for our portfolio companies. And if the blended sort of expectation is that the security is mispriced, then we will buy almost regardless of the volatility, because we are sure that we've done the work. In terms of how will these tariffs and the trade war affect the world, I think it's uniformly negative, right? I mean, ultimately, the reason why we have global supply chains is because it's more efficient and it benefits all of us. If you are going into a period of reversing that, I think there will be an additional cost for consumers. But perhaps if you compare Trump 2.0, if I may call him that, with Trump 1.0, first time round, he was very clearly going after China. It had a short-term effect, but not necessarily the big long-term effect you'd expect. What he's doing now is that he's almost attacking every single trade partner of China. So again, I think that the ramifications will be bigger, and maybe China isn't the only loser in that.
You mentioned also that emerging market trades historically cheap to the rest of the world, basically. Do you think that one gets paid for taking the risk?
Well, over the very long term, you have been. So the MSCI Emerging Markets Index came into existence in January 1st, 1988. And since then, I think in Swedish kroners, it's outperformed the developed market index by about 0.5 percentage point per year. Doesn't sound like a lot, but over the 30 years or 27 years of 37 years, that becomes quite a big difference, right? I think that return or excess return has been very cyclical. Again, there are periods where emerging markets are very, very cheap and the basis for future returns are very, very attractive. But on the flip side, after the great financial crisis, emerging market stocks had held up better than developed market equities, and therefore were relatively expensive. And we are coming out of the sort of a decade plus of underperformance because of that high starting point.
And how do you see passive versus active portfolio management in emerging markets specifically?
Well, I think this is something that everyone needs to do that works for their own investment goals, right? I think that the one thing that passive investments have over active investments is lower fees, right? So if fees is the only thing you want to look at, then maybe a passive product is better for you. I think the negative side of going passive is that you own a little bit of everything. I think in emerging markets, history has shown that there is quite a lot of index constituents you don't want to own. It could be because of ESG considerations, it can be because of political considerations, etc., etc. But I think that the risks that kind of downside plays out is higher in emerging markets than closer to home. Another point which is key to bring out is that in emerging markets, you've historically had a lot of IPOs. Now, the one thing that emerging market countries are good at, it's selling new paper to new investors at inflated prices. So when everyone wanted to buy Chinese equities, we were paying 3-4 times price to book for state-owned banks that we knew weren't there to make money, but because everyone wanted a piece of it, they could sell their stakes at those kind of valuations. Those same banks now trade at 90% discount to where they were IPO'd. So again, I think if you are in an index product, you will get every single overvalued new company in the index straight into your portfolio. And I don't think you want that.
Okay, thank you. Let's turn to Lars then. On the frontier market debt side, first of all, what is frontier market debt?
That's a good question, as there's no clear definition of what a frontier market is. But there's some kind of definition if we look at the benchmark, which is provided by the JP Morgan. The broad emerging market index covers basically all developing countries from China, Brazil, Mexico to Chile, Peru, and in Africa as well. So if you take the definition by JP Morgan, it's a subset. It's not an asset class in itself, but it's a subset of the broad emerging markets index. And their definition is max 2% and high yield. So what we are looking at is a much more concentrated portfolio of countries that covers roughly 35 countries globally. They are dispersed across the globe with 25% in Latin America, roughly 50% in Africa, and 25% in Asia. But every country is not in the top 15 countries of the broad emerging market. So it is smaller countries, or it's not smaller countries, but it's smaller credit markets. And what we are looking at is sovereign bonds issued in US dollars.
Okay. I mean, now we know from the statistics that Avanza released, I think it was last week, that many clients are investing. They return basically to high-yield corporate bonds in the fund format. But if you compare what you are doing to, let's say, corporate high-yield bonds, what is the big difference, would you say?
The big difference is we invest in sovereign bonds and not in corporate bonds, and corporate bonds has some different dynamics, and that's on a number of issues. Liquidity is one. We have great liquidity. It sounds like small credit markets, but it's a minimum $500 million size paper that is issued in the market. So we have great liquidity, daily liquidity. That's a difference from the corporate where liquidity can disappear. You also got a yield pickup in the frontier market, despite the yield has come down, and it's come more down in the frontier market than in the corporate high yield market. So that's a different. If we have really trouble in some of our countries, and that's actually a huge difference, countries don't disappear. I mean, a country can go into a default, stop making their payments to their creditors, but they won't disappear. They need to come back to the market, and that's a strong driver in the market development, which actually has, over the last 3 years, has created a lot of very good high-performing opportunities in the market. When a corporate defaults, it leaves the index the next month. Basically, it's gone. So that's a huge difference. And also that our countries that we look at is very dependent on concessional funding, as we like to call it. That's basically funding from the IMF, the World Bank, and all other multilateral organizations. And it can also be bilateral. We have seen China having a huge increase in their lending and being one of the biggest creditors to particular Africa for obvious reasons. All the minerals you can find there and natural resources, where particularly Europe and also US had been absent for quite many years. So the increase of China in that particular space has increased quite rapidly over the last 10 years.
What yield levels are we talking about? I mean, if you compare the frontier market debt yield in dollars to the corporate high yield in dollars, what levels are we talking about?
We're trading, or the yield on the benchmark is just below 9% presently. So it's still quite a decent yield, I would say. So despite these extremely high returns we have seen over the last couple of years after the COVID and the war in Ukraine, which set back the markets quite a lot, it's all recovered, and it recovered really fast. And that's because you had a very high yield, high performing. So despite these very high returns, we still have quite a decent yield compared to the high yield market. It has contracted, but you still get a decent yield pickup.
And what pickup over the high yield market?
Roughly above 100 basis points.
100 basis points higher.
Above 100 basis points, yeah.
When
we look at US high yield.
And if you look at let's say the universe of frontier market countries, how do you look upon this, let's say, optionalities, investing in a fairly relatively stable country, or going into the ones that are defaulting, or how should one think there? Where is the value? Where does the value come from?
There's two drivers, basically. The political development, as we look at countries, it's not like we look at corporates. It's the political, it's stability, it's how stable are the political cycle, are they doing the right stuff, and the second, do they have access to this financing from the IMF? Do they have IMF programs, and how do they progress on this? Then when they're going into default, it's about recovery values, and as we are looking at small countries. Moody's have made a study over since end of '88, which shows then on average sovereign countries has a recovery rate of 40 cents. That means that for every 100 notional they paid out, you get 40 cents back. But when you look at the small countries, it's just about 50 cents. So there's a much better recovery on the small countries, which also explains why you have a very fast recovery to recover your money, basically. Because when they come back to the market, you get quite a high yield, so it doesn't take a lot of years, and the market would, because it's a safe credit when they restructured, you would get your money back pretty rapidly.
What about correlations? I mean, how is it very correlated to the equity market or high yield market? What's the correlation?
The correlation to for example, is 0.56 to the equity markets. So a decent low correlation. It makes diversification, and we think that one reason for that is that when we see all this disruption coming from the US and making unfriends with the former friends and imposing tariffs, it's not something that really where frontier markets are in focus. Some of them had a decent export to the US, but that's primarily the Latin American countries. If you look at the African countries, it's they're not the focus point of the trade wars. If you look at it right now, so we think it's kind of a nice pocket to be where you can achieve a good yield, and the world focus is not on these. Contrary, everybody is trying to get influence in these countries, both from China but also from the West, because the green transition, the EV cars, etc., all the mineral and the stuff you need to get, you can't get it in China anymore, you can't get it in Russia. So there's some in Australia, but if you really want to have it, it's in Africa. So that's why you see this huge focus or new focus coming towards Africa, which is 50% of our universe.
Okay, interesting. I have a last question for you guys, and that is, you mentioned, Fredrik, that we have seen a decade of underperformance of the emerging market assets, basically. Are we going to see an outperformance of emerging market assets over the next decade?
Well, I certainly hope so, but there are no guarantees in this game. So all that we can say is that when valuations reach extreme levels, they greatly improve your odds of future performance. I think that the uncertainty that you have at the moment, the last place I would want to be overcommitted or overextended is in historically expensive markets where companies are making more money than they used to make. I'll just leave it at that.
And Lars, what's your view?
I mean, if we look at the last, back to the financial crisis, frontier market has definitely outperformed both the MSCI World equities, including dividends. It's also outperformed the broad emerging market. And I think this will basically continue, that we will see, not at least because of the high yield, but also because we will see special situations coming up along the way. And we are ready to take these opportunities, and we've been ready to take them and make performance out of it. And that's what makes it a very interesting market, basically. And if you look at just a very near example, I mean, the market is up on the index level a bit more than 2%. It's been a little bit of turmoil the last couple of days, but in the second half of 24, the market had a performance of 6% roughly, while you saw U.S. Treasuries going up. So,
all right. Okay, thank you, Lars, and thank you, Fredrik, and thank you for watching us today.